Welcome to Daybreak Australia. I'm Haidi Stroud-Watts in Sydney. We're counting down to Asia's major market opens.
I'm Annabelle Droulers in Hong Kong. The top stories this hour. A sell-off on big tech sends the S&P 500 to its lowest in almost 2 months. Asian equities brace for key economic data out of China.
Israel vows a response after Iran's weekend drone and missile attack, even as the US and its allies urge restraint.
And Goldman Sachs surprises with a 28% jump in first quarter net income, defying expectations of a drop.
Taking a look at how we're setting up just an hour away from the start of trading across major markets here in Asia, and we are looking like a bit of a struggle poised to follow Wall Street shares lower here in Asia. Latest evidence of stubbornly sticky US inflation really spurring these bets at the Fed. Again, no hurry to cut rates. We are seeing that uphill battle for both currencies and equities in this part of the region. We're seeing rising US yields putting pressure on that picture, and of course that prolonged wait for monetary easing as well. Also the China data aiding an extra event risk there on the horizon. We see Sydney futures off by about 0.8%. Some strength potentially when it comes to the Aussie dollar still to come as we continue to see surging metals prices. And of course, that is dependent in terms of what we get out of China today as that key China proxy. Kiwi stocks are down by about 0.6%. We are seeing New Zealand inflation headline CPI seen rising 4% from a year ago, tipping to slow as it heads towards the RBNZ's target band. So really questioning what that means for monetary policy for a central bank that was really ahead of the curve in this current cycle. Nikkei futures off by about 0.1%. We did see Japanese shares also falling in the previous session with these ongoing Middle East tensions and, of course, in the thick of earnings season as well, Belle.
Yeah, earnings, and then you can also compound that to retail sales, and that was really the big theme, as you said, in the session overnight on Wall Street, because they came in better than what had been expected. Consumer strength, and you couple that with a strong jobs market as well in the US, and that just tells us perhaps inflation at risks becoming entrenched. And the ramification of that, of course, is that the Fed stays high for longer in turn. That really drove the dynamic that we saw. We saw, for instance, the S&P 500 falling more than 1% at some points, going back below that 5,100 mark, even though you're sitting around that. And futures has become online fairly flat right now. And a lot of the losses coming through in the big tech space as well. Microsoft, Alphabet, or Apple rather, Nvidia, really some of the big laggards in the session. So those more rate-sensitive sectors in play. Otherwise, other themes we're tracking is really what we had in the bond space coming through. Most US Treasury yields climbed to new year-to-date highs. Two-year yield approaching 5%. We had the benchmark 10-year note rising as much as 14 basis points to about 4.66%. Heidi, so really at the Fed, and you combine that with geopolitics casting a little bit of a shadow right now.
In Bell, to that end, on the geopolitics front, we're seeing the US House set to vote on new aid to Israel and Ukraine this week following Iran's missile and drone attack over the weekend. Bloomberg's TV and radio political news director Jody Schneider now joins us from Washington. So, Jody, we're hearing about a split vote now. Does this potentially break the month-long roadblock that we've seen?
Well, that is certainly what the House lawmakers who discussed this afternoon are thinking, Heidi. We've heard from several lawmakers who were in those sessions just a few hours ago here in Washington with House Speaker Mike Johnson, and they came out saying that it's a split vote, that they're going to start with the Israel aid, given the urgency there of replenishing those defensive mechanisms that were able to really block those missiles and drones from doing any serious damage in Israel or much serious damage in Israel over the weekend. So they feel like that the urgency there will get that through, and then they will test the really willingness of Republicans and Democrats alike to vote on the Ukraine aid. Of course, Speaker Johnson has to worry about his continued future as Speaker, given that Marjorie Taylor Greene has threatened to basically go ahead with what we call a motion to vacate, which would really test his speakership, would put his speakership to a vote. And we've seen what happened last year to House Speaker Kevin McCarthy when that happened. So the speaker is hoping that this way he'll be able to really kind of test what's going on in the caucus and maybe get both Israel and Ukraine aid through. There's also a plan to try to do Taiwan aid in a third bill and some other measures, including some further restraints on Russia in a fourth bill.
So, Jody, does this appear to be a plan that would be able to pass Congress at all?
Well, that's the real question, isn't it? First of all, the Senate already passed Ukraine aid and sent it to the House. So if this measure were to be able to pass the House, it'd have to go back to the Senate. There's a lot of appetite for both support for Israel in the Senate as well as support for that Ukraine aid. But still, anytime that happens, it takes a while. The Senate has a lot of rules in terms of getting things on the floor. So this isn't going to be that quick necessarily. Congress is supposed to go on recess again soon. So there's a real question anytime it gets complicated. But there is thinking that especially the Israel aid would be able to get through. Now, they may have to do this under what they call a procedure that basically is called suspension of the rules, where you need a 2/3 majority, but allows you to move it through quicker. And Mike Johnson has done that before and been able to get some things through with a lot of Democratic votes as well.
Jody, what's been Israel's latest thinking when it comes to the calibration of a potential response?
Yeah, so we've, first of all, seen restraint continues to be what the U.S. is advising, what other allies are advising, basically saying take the win or take the fact that this was not worse, that this attack did not result in large-scale casualties and damage. But that does not necessarily seem to be what we're hearing from Israeli officials, most notably Benjamin Netanyahu, the prime minister of Israel, who's saying that there has to be some kind of response, that Iran's unprecedented attack from Iranian soil directly into Israel, even though there wasn't widespread damage, even though the defense mechanisms worked, that there needs to be a response. The real question, of course, is what kind of response, how significant, and would that lead to a wider conflict in the Middle East?
All right, that was our Bloomberg political news director, Jody Schneider there. And let's stay on that, bring in Mara Rudman, professor at the University of Virginia, and previously served in both the Obama and Clinton administrations, including as Deputy Assistant for National Security Affairs. And Mara, what do you see as Israel's next steps in this? And does that also align with what you think Tel Aviv should be doing?
Well, first of all, I want to say that I think that asking Israel to exercise restraint and Israel saying they're going to take some action are not necessarily inconsistent. There's a wide range of timing, nature, and type of action that Israel can take that could be consistent with President Biden and the international community's request for restraint. So I think it's important just to lay that out to start.
But what are the sort of scenarios that would constitute, for instance, a restrained response from Israel in this, that would also meet sort of the needs or the requests or the urges of its allies?
So, first of all, I would note that it took 15 days for Iran to decide what they were going to do and to signal it in the way that they went forward with the attack this weekend on Israel. It was in reaction to, and they made very clear, it was reaction to an April 1st strike against Iranian Revolutionary Guards who were at an Iranian embassy in Syria, that Israel has not taken responsibility for publicly, but it's widely assumed that Israel was part of that. So the timing of what Israel does, when Israel strikes, is an open question. And what kind of action? There are sanctions, there are covert actions, there are singular strikes against individuals, there are cyber actions. There's a wide range of different types of things that Israel could use to effectively deter Iran from further action that would minimize the risk of escalation, which is clearly what the United States and Europe and many countries in the region are concerned about.
Can you give us some context on how the dynamics of the Israeli cabinet play into its response as well?
Yeah, that's an excellent question. And I will say there are parallels to what your Washington political director was just describing in terms of the House of Representatives. And I'm happy to come back to that. So Prime Minister Netanyahu himself is currently managing to maintain his hold on the prime ministership by dint of 2 or 3 extreme right-wing members of his cabinet who are not part of the war cabinet and who have consistently put out positions that I believe are inconsistent with an actual view towards Israel's security and certainly to regional security and stability as well. And so they would be pressuring him, and they have been very public in their statements about pressuring him to do more, to be extraordinarily aggressive, to show no restraint at all in any way in terms of an action, and actions I think that are actually counter to Israel's direct interests. But Prime Minister Netanyahu essentially serves at their pleasure right now when he is running 20 points behind in polling in Israel. He's deeply unpopular, and his coalition stays in place because they are supporting him.
Well, this is the issue, right? Because we've seen urges for restraint being largely ignored when it comes to Israel's operations in Gaza. So should we expect anything different when it comes to allies in the US trying to persuade Israel towards restraint when there are these domestic pressures?
Again, I would use the word restraint quite carefully. I think there are certainly differences in views on strategy. The United States has been very clear that it supports Israel's interest and need to eliminate Hamas as a threat to Israel proper. It disagrees with it on the best ways to achieve that, and has also strongly pushed for increased humanitarian aid. And that's part of the reason for the disagreement now on going further in Rafah. These two actions are actually related in the sense that Israel has, and it may sound perverse, but an opportunity by a more careful, calibrated approach and response to Iran that can work in conjunction with Gulf countries, with other Arab countries in the region, who, by the way, very likely helped to repel the Iranian attack this weekend in various ways, some publicly, many more quietly. So there's an interest in an alliance with Israel vis-a-vis Iran. Part of Israel's ability to execute that on the long term, though, is agreeing to work towards a two-state solution, a Palestinian state and Israeli state, where Hamas is not in control in Gaza.
How does a potential response and how the next steps play out also play into the nuclear deterrence angle for Iran?
So the challenge of President Trump having left the agreement that all of Europe, that several European countries and China and Russia had joined the United States in 9 years ago, is that Iran has very much sped up, has broken out of the agreement entirely, and has sped up its ability to go forward with weapon-grade nuclear material. So it adds to the danger of the moment. I think there are not signs right now that Iran would utilize that, but the fact that they are so close to being able to makes it important to have a deterrent strategy that's effective, makes it important for Israel to be in alliance with other countries in the region that are very concerned about what Iran could and might do, and with the United States and NATO allies. The risk is high.
Mara Redmond, appreciate your time. She's a professor at the University of Virginia. Still ahead, the United Nations is hosting its first Sustainability Week at their headquarters in New York. We get more details with the UN General Assembly President Dennis Francis later in the hour. But first, we'll be talking emerging assets. The battle against the dollar strength scenario continues. Here why All Spring Global Investments is underweight India, Taiwan and China next. This is Bloomberg.
India's elections kick off with a focus on the economy, social divisions, and climate change actions that will influence the global story. Bloomberg is live on location with the latest updates from the world's largest democracy. Coverage begins April 19th.
Real interest rates now are considerably higher than they were before because inflation has come down quite a bit. So we will need to start a process at some point to bring interest rates back to more normal levels. Now, my own view is that that process will likely start this year. But again, it's going to be driven by the data and achieving our goals.
New York Fed President John Williams there speaking out about the Fed's rate cut path, I should say. Despite that view, of course, we saw stronger than expected US retail sales data, again reigniting these bets at the higher for longer narrative is what we're dealing with. And that in turn is putting continued pressure on EM currencies and really broader EM assets as well. Alison Shimada is the Senior Portfolio Manager and Head of Total Emerging Markets Equity Team at Allspring Global Investments and joins us now here in Sydney. Alison, so great to have you.
Thank you
person. What is the biggest sort of correlation for EM assets at the moment? Is it the strength of the dollar or is it the China recovery?
I think it's really the anticipation of the rollover of the US dollar. And also, I think near term, it is China recovery. So we're seeing a very slow recovery in China, but it is happening. And I think beyond that, people will hit the green button once we see some loosening of interest rates or decline of interest rates and subsequent rollover of the dollar. So we're anticipating both. I think they will both be positive for EM asset class.
Well, I think that there's a sort of the perception that these sort of Goldilocks financial conditions that have played out in developed economies and benefited share markets, EMs are still a little bit behind, right? So that's still to play out for you.
Absolutely, and that's why I think we remain constructive this year, and we see a lot of good earnings growth in emerging markets. We see payment of dividends and shareholder return, which we managed to as well. So I'm really quite positive this year, and I think that the economies have held up over the pandemic and coming out of the pandemic as well. So we haven't had any major dislocation in emerging markets.
Is China still the EM anchor, given that we have seen kind of almost a decorrelation, right? And are you positive domestically for China?
Yes, we are positive domestically, but we realize that policy plays a long-term effect on China, and we're very much looking forward to future policy in terms of the commodity sector, in terms of IT, in terms of the property sector, of course. So we do think that it is the anchor in emerging markets, still the largest country at 25% of the benchmark, but also we feel that you must stock select in India as well, because it's becoming a much, much larger market than it had been even 5 years ago.
Expensive though.
It is in certain sectors, like the consumer sectors and somewhat financials, but because we're looking as well at shareholder return and cash dividends, we're mainly in other sectors such as energy infrastructure, industrials, and areas that are not as expensive.
What about, Alison, in North Asia? Because I noticed, for instance, you're a bit underweight on Taiwan, but you are overweight on Korea. What's the difference between those markets that you're seeing?
Yes, in terms of Taiwan and Korea, they both benefit from AI infrastructure and interest in that particular technology. In the terms of Taiwan, it's had a very good run, and we're underweight because we took a bit of profit off the table. And I think that we're still hopeful and own a variety of stocks in terms of AI supply chain as well as semiconductors. And in South Korea, we have a large weighting to Samsung Electronics, as well as some other diversified holdings in the banking sector and telecom, et cetera. So we really feel very hopeful about both, and particularly with this turnaround and recovery in the semi sector.
And just talk us through some of your stock picks in particular, because I can see, for instance, you've got one in Taiwan that is still in the AI space.
Yes, Chroma Ate. And it's a really interesting company that I rarely see the sell side speak about or write about, but it certainly is kind of part of the supply chain for AI. And so and it has a reasonable between 3–3.5% dividend yield. So it's very interesting, very consistent, very relevant. And we also like other areas such as in Latin America, Southern Copper. It's an interesting thing because it will only become more and more important, copper. We're interested in select commodities, but copper has a very tight supply-demand situation at the moment. And also it's relevant to both AI, to IT, to telecom, to data centers, so everything, basically, EV. It's very interesting for us.
You mentioned Korea briefly, and you take a look at the astronomical run that we've seen for Japan and potentially further to go. How long do you think it would take for Korea to be able to replicate that with its Value Up program?
Yes. Well, I think it will take a number of years because it requires a change in corporate behavior. But I do think it's extremely encouraging. And, you know, I've covered Japan as well for 25 years, and I noticed it took them a long time to come around. But eventually the outcome was that people look at what happened with Japan and the corporate governance improvement. And I think both China and South Korea will follow in those footsteps because they see how much it helps the share prices. So I think in terms of the time frame, though, it could take 3 to 5 years, but I think that they will be strongly directed by the government.
Asia EM in particular was really in the crosshairs with the last Trump presidency. How closely are you watching domestic US policy, trade, and how that could potentially impact the outlook?
We are watching it very carefully. We know that there's a very high correlation really with all countries globally. And, you know, people are a little bit fearful about additional sanctions, particularly on Chinese tech stocks. So we are very cautious in selecting certain names because we have to think about that implication. We don't want to be cut off or unable to invest. But I think on the other side that, you know, it's already President Biden did continue a lot of Trump's policies. So if anything, status quo going into the next U.S. presidency, probably likely. And, you know, we haven't seen any aggressive action against Taiwan as people had feared. So post-election things have been rather calm. So I think that we keep an eye on all of these things, and it kind of goes integrated into our stock selection. But it's something that we have to keep an eye on 24/7.
The overcapacity issue in particular, is that affecting which stocks perhaps you're more cautious on, particularly when it comes to China?
Yeah, China actually has worked through a lot of that overcapacity, and it's coming out of that, and we're seeing a little bit more stable sort of production numbers. And I think it's going to be up and down a little bit, but I think that for the most part they've worked through a lot of that. And so I'm actually quite positive on the industrial side.
It's really great to have you with us. Alison Shimada, a Senior Portfolio Manager and Head of Total Emerging Markets Equity Team at Allspring Global Investments. And you can, of course, get a roundup of the stories you need to know to get your day going in today's edition of Daybreak. Terminal subscribers can find that. It's at TabyGo. It's also on the mobile in the Bloomberg Anywhere app. You can customize those settings as well, so you just get the news on the industries and assets you care about. This is Bloomberg.
Some of the latest corporate stories we're tracking this morning, and 2 of Tesla's top executives have left the company as the car maker holds its largest round of job cuts. Senior Vice President Drew Baglino confirmed an earlier Bloomberg report about his departure. Their Vice President of Public Policy and Business Development, Rowan Patel, also announced his exit. Tesla is looking to reduce its global headcount by over 10%, which could affect some 14,000 employees. Chinese battery maker CATL posted strong first-quarter profit as the company's dominance in the EV sector pays off. Its net income climbed 7% to $1.5 billion, while posting the highest gross margin in more than 2 years. CATL has vowed to keep expanding despite the cooling demand for battery-powered cars. And Hong Kong has given conditional approvals to several asset managers to start spot Bitcoin and Ether ETFs. Firms including Harvest Global Investments and a partnership between Hashkey Capital and Bocera Asset Management say they got initial approvals. OSL says it will provide custodial services for some of the products. More ahead. This is Bloomberg.
Well, shares of Goldman Sachs closed higher after the company posted a surprise profit jump in the first quarter. The bank recorded a 28% increase in net income, even as analysts had braced for a drop.
We feel very good about our first quarter results, which reflect the strength of our world-class and interconnected franchises and the earnings power of our firm. This performance was aided by the swift actions we took last year to narrow our strategic focus and play to our core strengths.
Well, let's bring in Bloomberg Intelligence Senior Industry Analyst Matt Ingram. And Matt, how much of this was due to really record bond sales?
Hey, Heidi. Look, it was obviously a very strong period in investment banking, but there were loads of moving parts and they were all testimony to Goldman's extremely strong client franchise. So it was more a trading beat, actually, than an investment banking beat. Mostly fixed income. I think they've really made a focus on supporting those key clients. Mortgages was a very strong area, as was structured credit. So I think investment banking was strong, but trading was stronger.
We have sort of seen Goldman Sachs sort of struggling a little bit to sort of define its businesses and perhaps, narrowing its scope a little bit under its leadership. Do you think that that sort of paid off in this quarter, that renewed focus on its core strategy?
Yeah, hey, Annabelle. Look, certainly that's the view of Alison Williams, our senior analyst who covers Goldman's in the US. They really narrowed their focus on those core clients and the core businesses. They did get a good free kick with markets helping them along the way, but they also really focused on tightening costs as well. So those two strings that they pulled, number one, focus on those core clients, and number two, focus on costs, generated that almost doubling of returns and that big uptick in profit. So Alison thinks they're on the right path with strategy, and that certainly capitalised on very strong markets in this quarter.
How much pressure is when it comes to funding costs, because we've got Bank of America next, JP Morgan and Wells Fargo both missed when it comes to that metric. What is the outlook, I guess, depending on what we see on the monetary policy front as well?
Yeah, it's a very good question. Obviously, bond rates have come off quite a lot, but what we're seeing in Australia, and the Aussie banks are big funders in US dollars, so the same applies to these US banks, is that there's still a fairly big uptick of sort of 80 to 100 basis points in what they're paying now versus what they were paying 2 years ago. So you are going to see a funding headwind still coming through for the remainder of the year. Obviously, it depends on the noises coming out of the Fed as to how much those bond rates come off. If they come off substantially, then that headwind subsides, but we don't see that happening at this stage.
But if we do see that Fed environment of higher for longer, do you see it? How do you see that having a big impact then?
Look, these banks are very much reliant on wholesale markets, Annabelle, and they're going to be replacing their funding. It's not like you have a big lump that comes through in one go. They're periodically replacing that funding. So in a way, what we've been seeing in our Australian banks and what we've written about certainly in Australia is it's almost death by 1,000 cuts. As you refund a $500 million or $1 billion bond, you're going to see that incremental step up in costs. The current cost of funding is now above actually where it was 6 or 12 months ago, obviously. But you're seeing a slowdown in that uptick. And so perhaps in another 6 to 12 months, you might see that stabilise. But if the Fed holds, you're not going to see it come off, which I think might be an expectation for a lot of the market.
All right, Matt, thanks so much for your insights. That was our Bloomberg Intelligence senior analyst there, Matt Ingram. Time for morning calls now ahead of the Asia trading day, and T. Rowe Price sees the Japanese yen continuing its drop to levels not seen since the 1980s. Global fixed income portfolio manager Quentin Fitzsimmons says the currency could slide another 10%. That's as the BOJ looks unlikely to raise rates significantly. He says it's not in the interest of Japanese authorities to have a significantly stronger currency at this point in time. Meanwhile, UBS says the combination of strong US growth and sticky inflation is raising the odds of the Fed hiking rates to as high as 6.5% next year. While the bank's base case is for 2 rate cuts this year, UBS now sees a growing possibility that inflation will fail to hit the target. Markets have already scaled back bets on policy easing, as recent US data has shown surprising strength in the world's biggest economy.
Well, New York Fed President John Williams believes the US central bank will likely start cutting rates later this year if inflation continues to gradually ease. He also discussed resilience in consumer spending and the economy in an exclusive conversation with Bloomberg TV.
The consumer spending has been strong. I think it is driven by strong fundamentals. Job growth has been solid. We've seen real wage gains. We're in a pretty strong economy with good growth. So yes, it's part of that story. But I think what we're realizing is we're getting a nice tailwind from the supply side of the economy. Good labor force growth, strong productivity, good real wage gains. So with that, I think consumers are spending.
What's the thinking in your office and among your colleagues about, does this last, or is this a surprise that you think could go away at any minute?
Well, one thing that makes it really hard to forecast is we're still feeling the effects of the after effects of the pandemic and Russia's war in Ukraine and all the things that have happened in between. So we're definitely still seeing an adjustment process by the consumer, in the economy overall. But overall, I think that the economy will continue to grow at a solid rate this year. Probably not as high as the 3.1% we saw last year, but something like 2% or around that. So I feel like we're still in a good place. Probably not as rapid a growth as we saw last year.
You do have the strong growth. You have very low unemployment. Why cut rates if the economy is doing fine at this level?
Well, first of all, I think monetary policy is working at the rates that we have now. So I think monetary policy is in a good place. Over the past 12 to 18 months, we've seen pretty much all the measures of imbalances in the labor market and our economy recede, many of them back to levels we saw in 2018 or 2019. So we're seeing restoring balance in the economy. We are seeing a slow decline in inflation. So I do think monetary policy right now is in a good place. I'm not fixated on where do rates need to go, over the next year. What I'm focused on is how do we best achieve our maximum employment and price stability goals. The data we're seeing show that the economy is strong, and that's really good news, and labor market strong. At the same time, we are getting better balance, and we're seeing some decline overall in inflation. So for me, it's really about getting that right, and then whatever we need to do to adjust monetary policy, we can do to best continue the progress towards our goals. So that's how I'm thinking about it, and we'll just have to keep watching the data and make the decisions based on those goals.
Well, is your base case that you will cut rates this year?
My own view is I think that with inflation continuing to gradually come down, and I guess I would say gradually is the operative word here, and with the economy remaining strong, I do think that given where the level of rates are, real interest rates now are considerably higher than they were before because inflation has come down quite a bit. So we will need to start a process at some point to bring interest rates back to more normal levels. And my own view is that that process will likely start this year. But again, it's going to be driven by the data and achieving our goals.
That was the New York Fed President John Williams speaking exclusively with our colleague there, Mike McKee. And taking a look at markets here because we're just heading 30 minutes out from the open for Sydney, Seoul and Tokyo. And at the start of the day, we are looking to be pretty risk off across the board. Nikkei futures most pronounced, that's the Singapore contract, but down more than 1% at this point. Overnight, it was really that story of stronger US retail sales that came through. We had surging Treasury yields across the curve. And so that tells us that the Fed likely to stay on hold for longer. And that's the message that investors are really adjusting to here. Weakness, particularly in big tech. We saw the likes of Microsoft, Apple, Nvidia leading the drop. So certainly a sector we're going to be tracking very closely. But we'll have more ahead on Daybreak Australia. This is Bloomberg.
The UN is hosting its flagship Sustainability Week in New York, bringing together policymakers and key UN officials to address global issues on tourism, infrastructure, energy and transport. The event is aimed at supercharging the implementation of the UN's 2030 Agenda for Sustainable Development. We're joined now by the President of the United Nations General Assembly, Dennis Francis. Really great to have you with us. Give us an update first and foremost in terms of the progress that's being made towards these goals.
Well, first of all, thank you for having me. It's a great pleasure. In 2015, the United Nations agreed to the 2030 Agenda for Sustainable Development, which involves 17 Sustainable Development Goals. The thrust of the Sustainable Development Agenda is to empower people to lift them out of poverty, marginalization, and deprivation. Because even today, there still exists something like 860 million people living in poverty, in abject poverty and hopelessness in the world, and a similar number who are hungry. Not to mention another number of people, another cohort, who are food insecure. So the Sustainable Development Agenda is really about lifting people, empowering them to live lives of dignity, and to do so in a way that minimizes the disruption and the harm to the natural environment and our natural ecosystems. For a number of reasons, progress towards the achievement of the Sustainable Development Goals have fallen off track. Progress has not been maintained at the rate at which it had been hoped. And of course, there are only 6 years left to 2030. So we need to speed up, we need to refocus and speed up in getting countries to undertake the necessary reforms that would result in the implementation of the Sustainable Development Goals. And Sustainability Week is designed to do precisely that.
You talk about the slowness of the progress, and in fact, there is no G7 country, including the EU as a whole, that has the policies in place to keep the world from warming less than 1.5 degrees Celsius from pre-industrial levels. So how, at an event like this, how do you make progress towards closing that gap?
Well, sustainable development is about significantly more, as important, in fact, as crucial as it is. It's about significantly more than climate change. Climate change is one dimension, an extremely important one, of sustainable development. But there are a number of other issues, really. There are issues, for example, around access to education, to quality education for all people, everywhere. Because as it stands at the moment, hundreds of millions of people, particularly people in poor developing countries and in far-flung rural areas, many of whom are women and girls, do not have access to quality education. And of course, there can be no development without access to education. So that's an important dimension of Sustainable Development Goals. As is the case similarly with health, that people need the guarantee of access to affordable basic health. And in many parts of the world, that is not the case. It's about climate change in part because, of course, we need to preserve our natural assets, the ecosystems that we depend on a day-to-day basis to give us the comforts in life that we enjoy. But it is about a significantly wider range of issues that, put together, will create the sustainable development that is necessary.
Even amongst the world's biggest economies, though, we're seeing climate ambitions that are being weakened, whether that's through scrapping different programs like low carbon programs, for instance, or backtracking on different regulations. Why is that exactly, do you think? And what's the best way to address that at a government level?
Well, of course, countries make their own determination. You would be familiar with the concept of nationally determined contributions to climate change. The concept involves everyone, every member of the international community, making a contribution to controlling and mitigating the effects and the impacts of climate change. But countries make their own determination based on a number of factors that are relevant in their peculiar circumstances. I'm unable to speak to the reason why countries might feel that they can renege on those commitments when, in fact, the evidence, the scientific evidence, points to the fact that the effects of climate change will become much more virulent and much more invasive, intrusive in our daily lives if we do not act swiftly to decarbonize the atmosphere. Decarbonization will require direct intervention by states at various levels, and not just states, by the private sector, by local communities, by towns, to rethink how we consume and produce given the dangers that we know exist with continuing the supply of carbon and other greenhouse gas emissions into the atmosphere. One hopes that enlightened thinking would in fact propel countries to act responsibly and to recognize the importance, the crucial importance of maintaining and in fact increasing the ambition of their commitments. Because if we don't, the consequences will be dire. There are some countries in the world, for example, in the Pacific region, where there is increased risk of inundation due to rising sea levels as a consequence of climate change. And some of those small countries in the Pacific have already entered into discussions with third parties to relocate their populations, should they in fact become inundated. So climate change is not the future, it's already here. We're seeing the impacts.
There's further complications, of course, and as we know, with developments at the moment being very fast-moving, the geopolitical aspect is complicating as well. Can I get your view on what the UN is thinking at the moment in terms of steps and options that are available with regard to the situation between Iran and Israel, and whether Israel will retaliate?
Yeah. I do not have a crystal ball, so I don't know. I know as much as you know. What the UN would like to see is no further escalation in the problem of tensions in the Middle East, because escalation is a slippery slope. And the only consequence, as I'd said in my statement released yesterday, the only consequence would be more death, more destruction, more misery, which I believe nobody wants. It does not serve the international community, nor even those who are directly involved in the conflict, that should be the case. We need instead really to be focusing in a very constructive way in getting a ceasefire in Gaza. Getting a ceasefire in Gaza, that should be where our main priorities lie at this point in time, in order to ensure that there is no further bloodletting in Gaza and that all the remaining hostages are released unconditionally and immediately.
Are there any further impactful measures and options available to the United Nations, both with regard to pursuing a ceasefire and improving the situation in Gaza, but also in terms of what the reaction would be if there is a further retaliation from Israel?
Well, we've made clear, the United Nations has made clear what is the action it would like to see with respect to Gaza. The ceasefire needs to be agreed, and we hope that will happen soon. In our view, it's long overdue. More than 33,000 civilian deaths in Gaza is not by any means, by any measure, a comforting statistic, particularly when you consider that there may well have been violations of international law and international humanitarian law. However,
Dennis,
yes?
do you think that the Iran strike, do you think that that sort of complicates or risks the chances of a ceasefire and also the hostage negotiations?
We have to wait to see what the consequences are. I'm in no position to anticipate what the fallout of that will be. The Iranians have said very clearly that having made the strike they made on Israel, they deem the matter to have been concluded. I take them at their word, and I urge them to maintain their word. But in terms of predicting or looking into the crystal ball to see what the impact might be, that is not something that I'm in a position to do. This is not a matter that bears speculation. I'd like to ask you to help us, the UN, to spread the word about choosing sustainability, which is actually the subject I thought we were here to discuss. Choosing sustainability is important because that is what will result in our ability to empower people across the world to live healthier, stronger, better lives in dignity and create a future that is inclusive and equitable so that everyone in the world has a chance, has at least a fighting chance to live a life and to self-actualize in the interest of themselves and their families. That is the development,
thanks so much,
that we seek.
Dennis Francis, there, President of the UN General Assembly. Thanks very much for your time and your insights across a broad range of very complex topics. And as we said, the UN hosting its flagship Sustainability Week in New York, and investments also pouring into green hydrogen energy or technology at this point in time. But Bloomberg's NEF data shows the industry's evolution is heading in the wrong direction. Costs are rising and there's even signs of overcapacity. Let's get the latest from Bloomberg NEF's hydrogen analyst, Kathy Gowan. Kathy, let's just start with costs here. Why exactly are they rising?
Yeah, so there are multiple reasons to it. First of all, inflation has remained higher than we expected, which results in expensive materials and labors. Government subsidies are also getting delayed to hydrogen, so we're not seeing the market scaling needed to drive the cost down. But more importantly, for this study, we actually the scope of the cost we included in this study is actually larger than last year. And this is because as we see more projects heading to the front-end engineering study phase, we found out that actually deploying a hydrogen projects require a lot of indirect costs, such as the cost of building a water tanks, cables, and all the other supporting infrastructure. The results of the study shows that due to those factors, the electrolyzer cost in the US and Europe has increased dramatically over the past year, whereas those in China has increased marginally.